Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities. We just recently had a Q&A session on Saturday going over some of the conference calls, some of the companies. We also went through some of the charts. There's a couple of charts that I shared with everyone, and some companies specifically going through their conference earnings calls and their charts. If that's something that sounds interesting to you, definitely sign up. We have a coupon code SPECIAL that is active. SPECIAL is the coupon code. 50% off the first month only, and a larger discount on the yearly membership. So we've got Nick here. It says Trump wants cheap $50 oil. Trump wants drill, baby, drill. You can't have $50 oil and drill, baby, drill. Mom says education is expensive. Trump is going to get schooled by the market. Yes, he will. Trump really can't do anything. He doesn't produce any oil. He can obviously tax it less, but I don't think that will be very favorable when oil prices go up. So the break-even point for oil on offshore, where people start to get interested in doing more offshore activity, I would say it's more like $70 to $90 a barrel. If we're at 50 or 60, offshore is going to be pretty weak. We're seeing the rig count drop. We're seeing drilled uncompleted well inventory drop. We're already at low inventory levels. The fair value of commercial inventory levels is about $89 a barrel, given history of where that is supposed to be being traded based off of inventory levels. So things don't line up right now. I think they're trying to push oil down, and no one's wanting to drill. And we're seeing the rig count go down, and we're seeing offshore drilling activity slow down. Price is too cheap. You can't have both. Isn't there a saying where you can have two of three things in a car? It's like cheap, fast, and reliable. You can have two, but not the other one. So you could have a slow car that's cheap and reliable, or you have a fast car that's cheap but unreliable, and you can only have two of the three. Seems something similar to that. Where we are now, so this is the stage that we go through, and we can walk through a couple, if you guys like, of this cycle. This cycle repeats over and over. These are the main stages of a bubble. We have the stealth phase, where basically no one likes it. People call you stupid for buying it. People say, well, why would you want to buy that? It's been down for 5 to 10 years, 14 years. Down here, your stealth phase is when nobody's looking at it. Awareness phase is people start to take notice just because it's been going up for a little bit. And then everybody gets scared out of it. That's your bear trap. This is your first pullback. It could be 50, 60% or something like that. In Elliott wave, this could be your first wave, and this is your big first pullback wave. If you look at Fibonacci sequences, depending on the size of the company, usually that first pullback can be 50%, 61%. And if you're in a really small company, they can go all the way back to 70-something percent pullback, this first one. It scares everyone out of it. That's when people with their name, with like, if they've got uranium in their name, they start, yelling at everybody on Twitter, specifically at certain people, blaming everyone else but themselves for not knowing part of this cycle here. And then once we start going, this was considered more like wave 3, where you get a big full move higher. There can be some chop. I would say between 3 and 4, there's usually a chopping sideways pattern over here, somewhere in the enthusiasm, greed, delusion phase. The new paradigm, that's when all the retail investors come in, tell you how great crypto is, because it's never going to fall again. It's just going to go to the moon. And AI, I think, is up in the delusion, new paradigm phase. Looking at this model here of people going through it, your low valuations are in the stealth phase. This is where things are really cheap, like commodities are in relationship to stocks. So when you look at multiple asset classes, some assets will be up here in the new paradigm. Other assets will be stealth phase, awareness phase, like down here. When you're down here, the relative valuations, this will be expensive. That's up here, and this will be cheap down here. This is how the cycle works. Money moves from one area of the sectors into another area that puts it into an overvaluation. These valuations and the way that this looks moves based off of cycles that are running behind it and subjecting the humans to these cycles. There's another graph that we're going to go over in a little bit talking about the cycle. So when you come into a recovery phase of real estate, the stuff down here are all going to be commodities. People shift money because of the market conditions of low inflation and low interest rates. Money can't get a return in bonds because they lower interest rates down to save the economy and the real estate market after it crashes. So they lower interest rates, they do stimulus, there's money coming in the system, but there's not a lot of inflation. So money basically moves out of bonds and goes into stocks and pushes stock valuations up here. That's your AI bubble. That's your crypto bubble. And all this stuff in the S&P 500 is very expensive. That's where all those metrics come from. It's money going into them, pushing all of the metrics up. And that's where the money is parked right now. So that's in the greed, delusion, and new paradigm phase. One can maybe even argue that the denial bull trap is being set right now. You could maybe argue that. It's very difficult to know exactly where you're at in this stages of a bubble, because when you're going through it, it's real choppy. And when you look back after you've gone through it, it looks quite obvious. You're like, oh, that's what it is. I mean, look how obvious that was. So the easiest thing for me to tell you is up here, things are expensive. You don't know specifically where you're going to turn at, but usually they're expensive. The next part of the cycle comes where inflation comes into the system, interest rates go up, and that starts to change money flows, because you're changing from a low inflation, low interest rate environment to a higher inflation, higher interest rate environment. And that generally starts to turn things a little bit differently. Plus, the valuations are high up here. So certain sectors, they are high. Other sectors, they are down here and low. And you can tell the difference between what sectors down here versus what sectors up here off of ratios and comparing those ratios to history. This is literally how I developed the three pillars. Market conditions is what changes these valuations. The ratios is what tells you what's cheap and what's expensive. And you can use a whole bunch of different ratios. You can use a price to earnings ratio, price to book ratio, price to net asset value. You can use the ratio of an asset versus an asset. You could do commodity versus stocks. You could do gold versus oil. There's a whole bunch of things that you can use. Then you can use technical analysis. In the stealth phase, you have bottoming patterns. The awareness phase, you're coming out of the bottoming patterns. And then the mania phase, this is kind of like your stage 2 move in Weinstein analysis and other stuff, where you get this big upward move. And then the cycle peaks, and then you get a crash, and then you start the cycle again of a bottoming pattern in the despair phase and stealth phase. And if you look at certain sectors, the entire sector possesses the bottoming phase pattern. Like commodities all have bottoming patterns. Over here in AI and crypto, I'm not so sure. I don't know how that works. It hasn't been through a full cycle yet. It's only been from stealth phase to new paradigm. It hasn't gone through this downward phase. 2009 was the bottom of the stealth phase for stocks like S&P 500, NASDAQ, AI, all that stuff. This was the bottom of that cycle, which is the recovery phase of real estate. We've gone all the way up, and we're just entering an expansion phase of real estate where interest rates and all that stuff go up, and this is about to turn over. So that's kind of where I think we're at in the cycle of different sectors. Commodities are down here because they do well in an expansion phase, and stocks and technology and stuff do well in the recovery phase. So this is what it looks like, and this just repeats over and over. You see it all over the place. It becomes super apparent if you start looking at this pattern and comparing this pattern. Now, sometimes you get a double top. A double top is just this return to normal. It goes up a little bit. It can even be higher than this one. This can be offset below, above, or equal. And then you get a big selling pressure move, and then generally you get like a double bottom down in the despair phase. And we can go over some of this. I can show you what that looks like. In fact, we'll do it right now. So this is oil. We'll do oil. I like oil. So the recovery phases are here. 1, 2, 3 consolidation patterns. That is this big recovery phase where you go despair and in the stealth and awareness into the awareness. That's what these are. These big phases there. This could be into the awareness phase coming up out of that consolidation. So the consolidation is this pullback here. It's this big pullback. Usually this is where the big consolidation occurs, the 3-hump consolidation, all that stuff. And then your first bear trap will be what we're in, the first bear trap. That's kind of where we're located. And everybody thinks it's a bear. Oh, we're going to crash. It's deflation. Most of the time they're wrong, but that's what this is there, and that's what this one is here. And then you get the big move higher. And these cycles, this cycle here is the same as this cycle here, which is the same as this cycle that we're going to go into. So it's 3 big cycles there where you come up, you pull back, consolidate, come up, pull back, consolidate, come up, pull back, consolidate, and come up. And that's your cycle repeating over and over and over. And that's what it looks like. Opposite of this, in 2008, where this peaked, you got bottoms in stuff like NVIDIA. So if you look at this, so this is your your tech S&P bull market. You could say it started in 2011, 2012, where the commodity bull market, depending on what commodity you used, is that. But the ultimate bottom of this cycle was 2008. And then you can see we got higher high, higher low, higher high, higher low, and then we broke out of this consolidation pattern. Think of this as that 3-hump consolidation from 1999 forward. You get that big consolidation. We broke out and then we ran. This all happened under the same market condition for the most part, which is a recovery phase of real estate. So this got expensive at the same time that commodities got cheap. Commodities were expensive here in 2007 and 2008. Commodities were real expensive here. And tech stocks were cheap because they've been grinding sideways for so long here in that consolidation. And that happens in all of them. Apple did the same thing during that rough time frame. So we saw 99. So here's 2000. We went all the way down here, bottomed in 2003, and then launched higher all the way up because the market conditions became favorable for that move. Amazon, they're all the same. We had a big peak in 2099. We rolled over. We consolidated in this time frame, and then 2009 we broke and ran out. Notice that they're not all the same. But the cycle, you want to buy these things when they are basically towards the end of the consolidation and they're breaking. This is a great time. Or even here would have been a great time to buy if you could have bought that bottom here or through this wedge pattern. If you notice if you look really close here, what this is you had a big move up in the 90s, and then this here is a head shoulder pattern. I'll put it right on top. So there's the shoulder, the head, and the shoulder bottoming pattern. If you can recognize that this is a bottoming pattern, you can get it on this right-hand shoulder there if you're really aggressive. At 72 cents in Amazon, 72 cents split adjusted, I'm guessing. And then if you can ride it and you know where you're at in the cycle, you just ride it all the way on up, all the way, all the way, all the way up. And right now, we could be trying to eventually peak out and go sideways, much like this here could have happened over here. So we're going to get this kind of consolidation that goes on for a little while sideways. That's the cycle. That is the cycle. And this is tech stocks. So these are expensive. So you can go and you can look at the valuations of these, and you can go look at the price to earnings and other things in its statistics. So price to earnings ratio is 35, expensive. Price to book is 7.18, expensive. If you were to go back and we were to look at, say, like the price to book ratio back in history, well, it doesn't go all the way back. So I was going to say, let's go back to like 2000, 2001, where it was bottoming. This was very expensive in 06, 07. You can see in 08, it got absolutely murdered, down to 8.21 on price to book, which is pretty expensive. We're at 8.13 right now for Amazon. So that's the cycle, just to show you as an example. Lumber futures are printing fresh 52-week highs. What this could indicate is that we have another surge in housing. A leading indicator is lumber, because that's what new homes need to pull from. They pull lumber to build homes. So if there's an increased demand for lumber and the lumber price starts to go up, that is indicating that we are in an expansion phase of real estate potentially. We had a little bit of a lull from 2022 to where we are today, and it looks like it's trying to pick back up, which is a good thing, which means we could be entering an expansion phase of the business cycle, because the expansion phase of real estate is the expansion phase of the real estate of the business cycle. That means that commodities outperform during that time frame, and then eventually we'll see technology and maybe some of these other areas slow down. They may not go up as much. And this is the cycle here. Most economies late cycle per fidelity. So if we kind of go in here, this is your recovery phase, your expansion phase. You go into a hyper supply on the back end here, and then you contract down, which is a recession, contraction. And then you go back and you revisit the recovery phase. China is actually in the recovery phase. It's coming right into it. That's their real estate market that pushes that into this area. In a recovery phase, that's when Chinese stocks will do incredibly well. So you've got Canada and China, at least according to this, per fidelity, is in the recovery phase. So that's where you could find technology stocks and other things do really well. So that's why a lot of people are very bullish on China. It's based off of where they're at in the business cycle, which is very early in the recovery phase. So recovery phase, and they're early in it. As you progress up, generally inflationary pressures intensify as you go through the business cycle towards the late stage business cycle. Your inflationary pressures, red equals high. You have very low inflation, so they lower interest rates, they stimulate in the beginning, and then they have good stock markets and technology markets and stuff like that. As you progress and go towards mid to late, your inflation starts to kick up, and your interest rates tend to kick up. So it gets all red. And we're right there. You can see it in an expansion phase where we kind of come through recovery, we get towards expansion, and this is where all your inflation comes. So that is US, Japan, Australia, Korea, Mexico, Brazil, India, UK, and then the Eurozone looks like they could be entering a potential contraction area. So that's kind of, this guy put a sector overlay. So as we enter, energy does the best here. We're coming right into energy. That's where I like it. Energy and materials are the outperformers. That's the late cycle inflation beneficiaries. And that's right where US is. So it's energy and materials that we're going to come into. Healthcare and utilities are towards the end of it, right before a potential recession. Technology is always on the front end here as we come up. Technology is one of the best to invest in on the front early half. Consumer discretionary and industrials all over here. So that's kind of where we're at. We just went through technology. That's why as the US went through here, everyone was so big on technology, but we're going to shift to energy and materials. And one of the ways that you can look at this and the way that we go through this cycle is you can go into like US, well, you can do crude oil. We'll do US oil divided by SPX. This here will kind of tell you where you're located in this cycle. And I think we're at the beginning of a huge shift where energy could dominate for a period of time. And that's the cycle. The business cycle is aligned for this to go up. We can also look at long-term, the oil cycle here, which is also well positioned. The circle there is the same as the circle here. So we are also positioned very well for energy to continue its move. It came off its bottom there, and then we're going to do something like that. And this is late cycle movement. And we're right there at that late cycle movement for US. And the US is important because the commodities are all priced in dollars. And what happens is when you come through this area, generally stocks start to roll over and the NASDAQ rolls over. So what they try to do is they try to lower interest rates to save the stock market. And what generally occurs is that you get a weakening dollar. And then the dollar weakening raises the price of all the commodities that are priced in dollars. So that's the cycle there. You can look at other areas like this is COPX, and this is our double bottom. So this is a bottoming pattern here. This whole bottom here, that's a bottoming pattern. And we've broken out of the bottom and are starting to head higher. This is part of the cycle. That cycle is saying that copper, materials, copper, and energy should be going up. So we're putting in these big bottoming patterns in all this, and we can see XLE. XLE is trying to break out into new highs. It's all part of the cycle. A lot of people don't understand this cycle. This is exactly what I studied for the most part in history. And the real estate cycle is what drives it. So when people say, "Oh, we're going to get this big recession," it's like, well, we're still in the cycle though, and it's driven by real estate. And we don't have a hyper supply phase of real estate. We don't have U.S. construction rolling over. We don't have all that stuff. So you're kind of premature blowing it all over here. We may not be in a recession now. Could there be like a mid-cycle wobble between a recovery phase and expansion? There is. And maybe that's what we're going through, is the mid-cycle wobble here, getting into an expansion phase. These recovery phases, this one lasted a long time. It went from 2009 all the way till, some people say the mid-cycle wobble was 2020. I'm not fully convinced. I think we could exit the mid-cycle wobble here any second and go into an expansion phase. This is what Fidelity is also showing. So I think we're maybe not as late as other people think. I think we're earlier than what most people think. That also aligns with when you look at the oil price and you take the longer term view. So if you back out and you look at this, I think that we're located like in 2001, where we could get a slowdown in technology. I think that's where we're located, and that's exactly where the fractal also points to where we're located. So that's my take, is that we're probably mid-cycle wobble. Maybe we haven't even exited yet. So that's where I'll end that section there. Cheap on love and under owned. That's how I see emerging markets today. Historically, these stocks have traded within an almost perfect upward channel, and they're currently near the lower band, and they're cheap. Yeah, so if you look at this is all part of this cycle here. What happens is when we go into these expansion areas, money starts to rotate differently. Sometimes when we roll over in technology stocks in the S&P, they lower interest rates. When they lower interest rates, the dollar goes down. This starts to go up to an overvalued state up here when they lower the dollar, and money starts to flow differently in the markets, different market conditions. If you look, you can draw, here's like a 3-hump consolidation here. So you got 1, 2, 3, and then we had one last one, and then we ran. We have 1, 2, 3. We have one last one, and here we're about to run again. So this cycle here just repeats over and over. Big cycle up, down cycle, up cycle, down cycle, up cycle, and it just goes over and over and over. This is the down cycle, or here we're in the stealth phase, awareness phase, and all the other stuff that's U.S. Based is up here because of the currency getting strong and money moving into U.S. dollar denominated assets. So that this is all of this, every single piece. This is connected to lumber moving up, which is connected to the expansion phase of real estate, which is connected to emerging markets being cheap and turning higher. They're all interconnected. It's the cycle that's driving it. Interesting that no one ever talks about Canadian oil decline rates. A Canadian oil company CEO was talking about a couple of plays that were pretty extreme. And there is some companies that have extreme decline rates with their conventional oil. Andrew, CEO of Schlumberger, stated that an accurate average oil decline rate is hard to estimate, but an overall figure of 8% is not an unreasonable assumption. That means that they have to find about 10 million barrels of new oil to stay flat, 8 to 10 million barrels per year. So that's 8 to 10 million barrels per day production to stay flat on we're a little over 100 million barrels. So it's 8 to 10 is what I'll say. Silver, 56-year breakout for your information. It's ready to rip. This also goes up when interest rates go up. Been saying since the dashed line breakout that silver is now on a mission back to all-time highs. And this time silver will break out of a 45-year cup and handle. So the overshoot this time should be massive, maybe reaching $60 or $70 an ounce. Very big picture, silver is doing great. It is climbing up the right side of the massive handle, and it is in catch-up mode. Both metals resumed their secular bull markets with the dashed line breakouts, which I posted in real time. And as said, if one does not have patience with a magnificent, truly historical setup like silver has now, one needs to do some serious soul searching. So patience is required. It is ready to rip here. We have a large divergence. If you can look back in history, there's been a couple of other times where we've had divergencies that have closed. But we have a big one going on right now. This is unbelievable. Rigged is what he is saying. Where would the Bitcoin price be without Saylor buying it? It's a Ponzi scheme. MicroStrategy represented 28% of the flow into Bitcoin last year per JPM. 28%. Wow. We've got lots of laughs. Okay, so the housing shortage theory due to demographics seems like such a load of bullcrap right now, right? There was never a shortage. Look at the housing inventory, all short homes. We've got homeowner vacancy rate down at the lowest levels in history. And we've got Americans turning 35 annually since 1970. It's at a peak. You can see that this is going up into 2024. This is your demographic putting pressure on the real estate market. That's why we're in an expansion phase of real estate. And here is your U.S. housing oversupply, undersupply of vacant units for balance. Look at how undersupplied we are. So in order to talk this crap on the right here, this guy doesn't know anything about the housing market. This is your real estate market. And everyone just laughs at these people. They have no idea what they're talking about. This is the data. Then argue with the data. Yeah, we're underbuilt. Tell me how we're not. Tell me how we don't have a bunch more people coming into home buying years. We've got 5 million. There's your data by John Burns Consulting. We have vacancies that are at all-time lows. Good luck. Now, home sales are down. Well, how do you explain home sales? Well, affordability is also a play in this, and interest rates. They've come in and they've slowed the whole market down. They shut it down. What are they doing? They're controlling the inflation being driven by this. This is inflationary that I'm showing you. So how do you slow down inflation? Jack up interest rates and stop the housing market from creating all these new homes and new loans. Slow it all down. That's what they did. They're slowing this down. That's where home sales come into play. They're slowing it all down. Warren Buffett says the biggest thing about money is time. You don't have to be particularly smart, you just have to be patient. Gold closes at $3,001, achieving its cup and handle breakout target. What's next? In my study of historical cup and handle patterns that are most similar to gold, rough comparisons because nothing is close to great, the patterns went from the measured upside target to the log target in 6 to 12 months. The log target is basically the percentage target. For gold, that comes out in around $4,000 an ounce. So that's probably where we're going to end up here shortly, within 6 to 12 months of that breakout. But that's all I've got for today, guys. Hopefully you enjoyed it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And that's all I've got. So we'll catch you next time. This is Finding Value.